3 days straight of maandamano, Monday, Tuesday, Wednesday, until William Ruto understands that the people are suffering.
Imagine ati KRA inaingia kwa simu yangu, inaangalia M-Pesa kama niko na Fuliza ama kama niko na Domingi. Imagine kitu kama hiyo. Si basi tutaachana na Safaricom tuweke pesa kwa nyumba. Tutaachana na Safaricom tuweke pesa. Itakuwa aje mimi pini yangu wewe usha access kila kitu kwa simu yangu. So mimi maisha yangu haiko ni security. By the way, maisha yangu haiko ni security.
Finance Bill 2026-2027 that is currently before the National Parliament of Kenya. I want to break down some few things that have been shared, and this information I got it from Faith Odhiambo's X page, so they are not my original compilation. The government target to raise Kenya shilling 3.6 trillion in revenue for 2026-2027 and a wider budget deficit of 5.3 of the GDP in the 2026-2027 fiscal year, that is July to June, up from 4.7 in 2025-2026 budget. These are not unreasonable fiscal objectives, but the manner in which the burden of achieving them is distributed is a cause for serious concern. 1. On tax filing timelines, this is very critical for you to note. The bill moves the income tax return deadline to April 30th, which is 2 months earlier than the current June 30th, and compresses the nil return filing to January 31st. This reduces the time available for audit completion, cash flow planning, and compliance. For small businesses and individual traders, this is not administrative reform. It is an additional compliance cost they can ill afford. 2. On Mitumba, the bill inserts a new section 12H into the Income Tax Act, which deems profit at 5% of customs value payable upfront before goods are released by KRA as a final tax. A trader importing a bale worth Kenya shillings 1 million pays Kenya shillings 50,000 regardless of whether they make a profit or loss. I cannot in good conscience describe this as equitable. 3. The bill increases residential rental income tax from 7.5% to 10%, absent a serious enforcement framework. This will drive non-compliance rather than revenue. The government must fix the enforcement gap before it increases the rate. One without the other is burden shifting. 4. On digital financial services, the bill removes the existing VAT exemptions on money transfers and payment processing. These are the tools of financial inclusion that millions of Kenyans, including the very people this government says it wants to reach, rely on daily. Making them more expensive will not serve the objective of a broader tax base. 5. By including interchange and merchant service fees within the definition of the management or professional fees or withholding tax purposes, the bill introduces a compliance burden into automated banking processes. That burden will be passed on to businesses and ultimately to the consumers. 6 or 7. The amendment to Section 24 of the Income Tax Act empowers KRA to deem at least 60% of companies and distributed income as dividends for tax purposes. This fails to account for legitimate decisions on reinvestment, working capital, and business growth. It is a retrogressive measure that sends the wrong signal to the investors Kenya needs. A 25% excise duty on telephone for cellular and wireless network is proposed. A phone is not a luxury. It is how Kenyan bank, communicate, conduct businesses, and access government services. Parliament must interrogate this carefully. On Biii, Kenya were led to expect relief and restructuring of the tax bans to ease the burden on salaried workers. The proposal does not appear in this bill. That is not a minor omission. an explanation is owed to every employee.